What should I know about Veritasium?
It was under the blood moon. I felt my heart come. I held you in this strange light, a place where shadows run. Even as I kissed your glowing skin.
So basically, I'm looking to tie the entire world through Veritasium. So this video is going to be on the real estate market. People have asked me, do you think we're in a real estate bubble, or is real estate going to bounce back? The most important, or the most, I guess, often asked question and statement is taken from the media. Well, this is going to be a V-shaped recovery, so once the virus is over, we could jump back into real estate. It's going to bounce back. No. Let's go over some facts. What you see playing in the background is a spot of downtown Brooklyn, from a vantage point in downtown Brooklyn and Fort Greene, Brooklyn. Downtown Brooklyn, Fort Greene, Brooklyn is one of the most vibrant real estate markets of the last 15 years, 20 years, I'd say, in the U.S. You know, lots of fundamentals through gentrification, benefited from the big credit bubble. Also, you had the credit pop, the real estate pop, and then you had the reflation from the extra Fed dollars that pumped it right back up. But you see, the mortgage market was broken in the late 1990s, 2000s. We had a big crash. The Fed spent almost $5 trillion reflated, but never fixed the market, and it's broken again. Why do I say that? The Fed is putting another untold trillions of dollars, a record, into these markets. Yet we have the exact same problems now that we have before. You see, from one spot, sitting in one patio in Fort Greene, Brooklyn, 10 construction projects. These are skyscrapers and very high-end, very tall high-rises. Lots of density, adding significant supply to a market that has standstill demand from an actual depression. Okay, so let's go through the fundamentals of real estate. Okay, real estate prices are a result of a combination of several factors. Supply versus demand. You see supply up there. Demand is a function of population. It's a function of income, wages, and corporate income, earnings for office and retail. It's a factor of credit and liquidity, the availability to get loans. Okay, you mix these things together, and the macro environment, of course, right, such as inflation, etc. You mix these together, and you get real estate prices. So let's take this step by step. Here you see the continuous claims for uninsured employment, unemployment insurance, for the last 8 recessions. This includes the Great Recession, which was the most significant financial event since the Great Depression, and 6 recessions or 5 recessions before then. Unemployment claims are directly correlated to the amount of income available to buy real estate. Okay, take a look. Right, we actually had to adjust this graph. Take a look at the unemployment claims over just the 8 weeks as compared to the entire Great Recession of 2007, 2008, 2009, and the 6 recessions before then. And if you could go all the way back, compare that to everything, including the Great Depression, you see the amount of unemployment claims, or they didn't necessarily have unemployment insurance, but the amount of unemployment increased significantly faster over the last 8 weeks than it has in any time in U.S. history, any time at all. So where's the money going to come from to buy real estate and pay mortgage? To buttress the argument made by the unemployment claims numbers, let's take a look at compensation of employees, wages and salary. It fell off of a cliff, literally. Just look at the line. It's self-explanatory. Enough said. Again, who's going to pay the mortgage? Who's going to pay the rent? And who's going to buy the houses? Next up, re-examine credit, because again, credit provides liquidity, and the more credit or free-flowing credit you have, the higher prices, the lower free-flowing, the lower the amount of free-flowing credit you have, lower housing prices. So if you take a look at that line right about 2010, 2011, you can see where housing prices came from. You know, significant credit was poured into the market to try and reflate the bubble that was popped. The reflation came from the Fed, but all of a sudden, reality hit. Now, contrary to popular belief, and if you look at our other videos and our research, the market was falling and collapsing, the bubble was popping before COVID hit. COVID provided cover, but COVID is significant. It's a worldwide event, once in every century or so. Okay, you combine a popping bubble that was inflated or reflated after the greatest financial issue since the Great Depression, combine that with a global pandemic, a once in a century or so event, and you have a significant problem. Take a look at how quickly banks started pulling back credit. Within the last few weeks, again, it fell off of a cliff. Do you remember when I said that housing prices have to do with income, but also with inflation? Consumer input inflation, or input price inflation, basically how much it costs for people to live their lives, is very important because it dictates how much discretionary income there is, which dictates how much you have to do things such as buy houses, renovate houses, live, enjoy yourself, etc. Take a look at this graph that was made before the COVID shutdown. It was made early 2000, say January, very, very early February. And then take a look at the upgraded graph, factoring in the massive bumps in unemployment. Significant difference. We're already in trouble. That black line represents the break-even point between expenses and income. Everything under that line is affordable to the family. Okay, and the colored areas under that black line is a surplus. When the colored areas get over that black line, you get a deficit. The deficits are usually handled by short-term and longer-term credit, but primarily short-term credit. The most expensive credit available to consumers, credit cards and personal loans. But banks are pulling back significantly on credit cards and personal loans. As a result, you will have defaults because people are going to eat and they're going to seek heat and shelter. And when they can't afford shelter, first the credit card goes and then the mortgage goes. Okay? Now, the second chart shows what happens if a hard currency was used for compensation. Okay, a hard currency, and this is our public service announcement, such as VE gold. The gold prices have always held their purchasing value relative to fiat currencies. Over any 10-year period throughout the creation of fiat currencies. For those of you who aren't familiar with gold and how gold relates and correlates to fiat and sovereign currencies, fiat being currencies that are issued by governments that are backed only by the faith and best efforts of the government, it is amazing to see how much value fiat currency loses relative to gold, or conversely, to see how much gold maintains its purchasing power relative to fiat currencies. This is not over a short period of time. Of course, there's some volatility, but over any 10-year period that you can find, gold has outperformed practically all fiat currencies, or all fiat currencies. Not only over any 10-year period, but over the entire life of the fiat currency. The average life of a fiat currency is 40 to 50 years, with the US dollar being one of the long time outstanding, one of the outliers, okay? That doesn't look like it's going to end anytime soon, but the US is rapidly and aggressively debasing its currency in order to fund the efforts of both the COVID lockdown and to try and reflate the bubble that burst back in 2008, which was reflated again, and it popped again and looking to reflate it once more. Every time the US dollar is debased or printed, Every time the euro is printed, the pound, the yen, the renminbi, the franc, and everybody else, gold increases in price. Or, to be put more specifically, increases in value relative to the fiat currency, because the fiat currencies actually decrease in price. Now, as you can see, it's very, very easy to purchase gold, either digital gold through the blockchain that you keep in bearer form in your own wallet, or as for how to access said gold, you can look at the video that's to the right of the screen, and you can see that a user actually purchased digital gold, easily redeemable for physical shipment by a push of a button, in the same amount of time it took for me to describe the difference in pricing levels and hardness between gold and fiat currencies. Yes, the VE Gold system is just that efficient. I welcome any and all to go to the links at the bottom of this summary in the video. Visit VE Gold, register, and purchase digital gold, silver, or palladium. Now, last but not least, remember there was another criteria or input for housing prices, and that is, another input for real estate prices, and that is earnings. Okay, not just personal earnings, which would be personal income, which we addressed in the early part of the video, but they're corporate earnings and corporate income. Now, the earnings are reported quarter by quarter, and the most recent quarterly earnings only captures about 8 days out of the pandemic lockdown. But the equity market is slow and easier to manipulate than the bond market. So when we looked into the fixed income market, we see signs of stress immediately. Okay? One way to look at things is just to look at debt worldwide. Corporate debt, non-financial corporate debt, loans, and debt securities as a percent of GDP, which basically shows you how much companies owe as a percentage of the amount of value that they produce. And it says it all, basically. You know the old saying, one picture says it all, or speaks 1,000 words? Well, this one picture shows many countries have debt to GDP, corporate debt to GDP, over 100%. So once your debt goes above 100% of what you can generate in terms of value annually, you will never, ever, 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 ever pay it off. Enough of this Reggie Middleton analysis, veritation research, conjecture. Is this really happening in the real world? Well, let's take a look at that market that I said was so vibrant, so fervent. Only one contract signed for a sale above $4 million. This is in a city where you have 54, 60, $70 million apartments. Worst week since February 2009, the Great Recession. Contracts that were canceled, 67 canceled in March, 43 canceled in April, and we're just getting started. Okay, the market is crawling, slowing to a standstill. Of course, it's against the law to actually show apartments. The average price cut in April was 10 to 15%. Brokers expect prices to fall up to 15 and 20%. I personally think that they're out of their minds. It's going to fall a lot more than that because we're going into the Greater Depression. But many people tell me, but I heard in the media, I heard in the newspaper that there's going to be a V-shaped recovery. Once this is over, we're going to bounce right back up. Even if there is a recession, once the virus is over, then the economy opens back up and markets resume. Well, let's take a look at what happened during the Great Depression. How long did the Great Depression last?
10 years. According to The Balance, the Great Depression was a worldwide economic depression that lasted 10 years. It began on Black Thursday, October 24, 1929.